what's that advantage point? Like a wick fill or like a top of the range. Like let's say like where the clean traffic starts to end at, you know? So in this case, like if we took the entry off the 30-minute candle, our advantage point is going to be as it comes down, because if it's coming up for a top wick like this, right? And it's printing a top wick, and that's the first thing it does. With the 30-minute close that closed below this range, you would assume that the 30-minute candle will then create a top wick to drive down. So as it comes up, creates a top wick, this is what you're expecting, a flip. So if you can take a wick entry and that happens to be the top of the range, as it comes down and flips bearish, that's your break even now, because there's a very low chance that price has now to reflip bullish and then break the highs, right? And then that advantage move that you took was basically just a volume flip of the candle to drive down, and that's it. That was the idea behind the trade in this case. But sometimes advantage points might be a little different. It might be based off support and resistance of the wick fill, right? Like in this case, I think earlier on today during the morning NY session, the entries we potentially could have had at 48, the advantage point was even so. Look, if this is your support on price over here, right? If this is where price closed to the left over here, right? If this is where price closed, right? You see how you close bullish back into the range here? This is the range we're in. So if you were to, we're looking for entries around 49, 50-ish levels. So if you were to like come up, fill the top of the range, sure, I'll look for sells coming down, right? Because your advantage point now is that even if price were to be in a position to drive up and reverse, because you gotta think about it from the other perspective. And the other perspective is, okay, if you don't drive down, then you're gonna drive up, right? But if you do drive up, what needs to be formed before you drive up? What needs to happen? In this case, like if you see the account coming up like this, you would assume that if you're breaking out the range, you at least one, have a bottom wick on a bullish candle, or two, you would probably have the breakout lows, whatever the case may be, to drive up. So then you have, or even this, right? So then as it comes up here and it creates a top wick on this candle, you can take an entry at 49, understand that, okay, worst case, you don't drive down, you drive up, you will still, one, have the advantage of coming down to create a bottom wick before driving up, which in this case is going to be the yellow highlighted box. And then the next entry is going to be the pink highlighted yellow box, which is going to be here, right? Because if your entry was in this green line here, right, and that was your entry, that is a green line at 49, worst case, it doesn't come down on this candle for a bottom wick, it will come down in this candle because you're closing above the range, and then that could be your exit point. And if you understand that structure, you have an advantage point, because you understand that even if price were to drive the opposite direction, it would have to come down to grab these orders before you're coming up, and therefore if you're in sells, you have a better spot to exit. Whereas if you were to, for instance, go back to our old trades, right, and you were to like take a trade like down here, for instance, like, you know how back then we'll be like, okay, yeah, cool, resistance here, support here, a closure below here should be good for us to drive down, right? The thing about that is any given point, right, in this case especially, since the structure is still bullish, as you take a sell here, right, any given point, price may just end up coming back into the range. And if it ends up doing that, then you don't have an advantage point, because if price breaks back into the range, there's a very low chance you'll come back down to your entry point, which would have been down here like 2 years ago, right? So that's why this year we evolved to the way we trade now, because we have better opportunities to get out of the trade if it weren't to play out in our favor. So that's what I mean by advantage points. There's like a lot to it, but it all has to do with price action at the end of the day. So like whenever you tap your advantage point, it's fucked after, because like you tap that zone and now it's like anything can happen, right? Like you see how earlier on we're looking for sells down towards 43, 44. After a tap 43, 44, you see the fuckery it has now. You see like how much like it struggled to break. This is what I mean. Once it taps these levels, it'll make a decision. It'll make a decision to either like range or break out or whatever the case may be. But at least you understand that it has room to come down, so you can take advantage of that pull down. And then once it taps that zone, you kind of want to just, you know, wait a little bit, wait for price to set up a little more, maybe wait for more candles to close, and then cool, once it breaks out the zones here, you have a better direction of where it's headed next, and then you can plan out your next advantage points, right? So like that's how I see the markets nowadays. It's just all on advantage points. It's like, what's the best entry I can take here with the best exits, right? And that has to do a lot with just experience in general too. You need You need to kind of go through the old stuff to understand the new stuff that I kind of taught over the years. Yeah, that'll be another more downvote channel for sure. I'll clip that up. But that's the vantage point. That's why I'm gonna update the course with by the end of the year, because I feel a lot of people don't understand what that is, or even wick enters. Why don't you need liquidity to be taken today? I needed liquidity earlier. So earlier on at like 58 levels, 59, that was potentially going to be the liquidity to drop down, right? But it didn't tap it exactly. So I'm like, okay, well, a couple things can happen here. If this is your resistance here in price, and then this is your support down here in price, as it closes below like 46 of that range, or even below here, anything below there should be good to drive down towards 43. So I was looking for sells coming from basically here down towards the bottom of the range, because that was a continuation on price if you were to close below, right? And the 30-minute candle did close below. So I'm like, okay, cool. If you already grabbed liquidity, if that was it, because you never really know where liquidity is at the end of the day. It's just like support and resistance, right? But as it closes below the range and prints new lower lows and lower highs, you're assuming that that structure should lead up to a continuation of that price range, which in this case, it drove down. So you would assume that, okay, if you create a top wick here already, and then you printed all this down here, then you should be able to drop down towards the bottom of the range. And that's kind of your pull there.